Thiru, we have 158 people.
Yeah, we are going live. Yeah. 1 minute, I'll just. Hi, Natasha. Am I audible?
Yes, Thiru, you're all right. Yeah, I can hear you.
Yeah. Good evening, everyone. First of all, warm welcome to all of you for the most awaited weekly Your Market Navigator expert series. Today we are with a new expert and we are starting our call today. Hope you have enjoyed our last week voyage 2022, ninth edition, where the theme was Team India Navigating with Resilience. Hope in this thing we have most of the time, I think the markets were very volatile. And as usual, every year we used to do our voyage. This year we had in our panel policy influencers, industry stalwarts, and international speakers enlightened us about the path ahead and spoken about topics where most relevant to the market players like you. Our stellar lineup of the speakers in the last week voyage was Mr. Anantha Nageshwaran, Chief Economic Advisor, Government of India, Mr. KV Kamath, ex-banker, and Mr. Mark Mobius, founder of Mobius Capital, and Mr. Tim Moy, MD Global Investment Research and Goldman Sachs. Along with these panelists, as always, our investment team experts led by our CIO, Mahesh Patil, presented interesting insights on the resilient Indian story and guided our investors and partners on the future of investments. Hope you have attended the session. If you have missed this session, no need to worry. We have curated
recording in
recordings
progress
of each session so that you can revisit at your convenience. The link is available in the chat box. So you can click and you can save that link, and whenever you are free, especially the long weekend is coming, and you can watch these videos without fail. So coming back to today's agenda, the discussion is on the prospects of ABSL Small Cap Fund and Balance Advantage Fund. I think today with us, Mr. Vishal Gajwani is there with us, and who is having more than 15 years experience in equity research and portfolio management. Vishal has an extensive experience of managing equity portfolios across investment cycles. He, along with his team, is accredited with conducting differentiated market studies, capturing interesting insights. Recently, he has done every annual outlook. He has shared trend spotting. It was well appreciated by every distributor in India. And he was talking about different market cycles, different themes will work, and he has identified 5 major themes, and he has showcased that going forward these themes will play out in the market in the growing economic conditions. So he is also gold medalist chartered accountant and holds a master's degree in commerce from MS University of Baroda. Vishal received 4 gold medalists and including Chancellor of Gold Medal for topping the Master of Commerce exam. Vishal is also CFA chartered holder from CFA Institute, USA. So he's having a very rich experience overall. Am I audible?
Yeah, Thirumala, go ahead.
Sorry, I think I'm getting it. Sorry, welcome Vishal for the Navigator series. I think due to technical, I think the network is not, network is fluctuating here. It is heavily raining in Bangalore. So welcome to the Navigator series. Before we talk about the
Tirumala, I can't hear you. Yeah, let us wait for 2 minutes for Tirumala to come back. While Tirumala joins, in the interest of time, let me share my market outlook with all of you. And meanwhile, we will also have Tirumala back. Good evening, ladies and gentlemen. I'm Vishal Gajwani. As Tirumala mentioned, I look at two portfolios for Birla Sun Life Mutual Fund. One is the small cap fund, and the second is Balanced Advantage Fund. Prior to this, I was with Birla Sun Life PMS for almost 9 years and have been managing multiple mandates over there. Starting with market outlook, if I look at the top of the mind concerns today among investors, the top of the mind concern today is how the inflation is shaping up because of the geopolitical tensions that we have seen. Increase in commodity prices, almost all commodities, be it base metals, be it energy commodities, have zoomed up. The prices have gone up anywhere between 15-20% to all the way to 50% plus. And that thing is leading to inflationary pressure globally. We have got Tirumala back. Tirumala, are you able to hear us?
Yeah, Vishal, I can able to hear you. Sorry, due to rain, the network is very slow here.
Right. So in the interest of time, I started updating on the market outlook. So
yeah, that's great.
Yeah,
you can go ahead.
Perfect. So what I was mentioning is that among the top of the mind risks and the concerns that we see at the moment in the investors' minds, and the first one is inflation risk, and which has been playing out. By the way, we have seen the headline inflation numbers being printed in US, in Australia, New Zealand, in India. These inflation numbers we have not seen in many years in the past. For example, the US headline inflation number printed last week was among the top highest Y&Y growth that we have seen in the last 40 years. And clearly across the globe, we are seeing interest rate increase, talk of that, or actual increase already happening. Even New Zealand, by the way, yesterday raised their interest rates by a big margin. The heated inflation that we are seeing globally is also leading to central bank action across the globe, where bankers are giving hawkish commentary firstly, and at the same time increasing rates and giving a guidance of further rate increase into the future. What this has led is that it has led to hardening of yields across the yield curve. Even the longer tenor yields have actually moved up. 10 years plus yields have also gone up. So inflation and interest rates move in sync, which is what we are seeing is already happening. But how much of it is sustainable and how much we should be worried about? So right now, what inflation that we have seen right now playing out is more of a supply side concern. While on the demand side, things were improving post the COVID lockdowns ended. But at the same time, today's inflation is more to do with supply side rather than demand side. But at the same time, one cannot rule out the demand also being stronger than anticipated over the next 1.5 years. So what I would like to say is that inflation is here to stay, and so are the higher interest rates. for the next 2-3 years, as we see, both these things will continue to be there. If I look at the historical perspective, last 20 years, 30 years, all inflation and all interest rate increase is not bad for equity markets. In fact, what we have seen is that the initial 50% up move in the central bank interest rates is actually positive for equity markets, because many a times increase in inflation and interest rates is in response to higher demand. And that's where I believe that part of the inflation and interest rate story, if it is led by higher demand, and if that inflation is managed well, I think that ends up being positive for equity markets. So that's on the two big concerns on inflation as well as interest rates globally. The third concern that I have come across and is about valuations, where the valuations have moved up dramatically in the equity markets over the last 2 years on the back of post the COVID crisis, where a lot of money, cheap money, is chasing equity markets, and which is where the valuations have seen an uptick. I think there is no easy answer to that, because valuations have already moved up. On the positive side, if I look at it, the valuations, the reason why valuations are so high is because of the fact that the earnings expectation, earnings growth expectation is pretty sanguine, where the market is expecting upwards of 20% plus earnings growth in the Indian context for the next couple of years, 2-3 years, which is what is getting reflected in terms of higher valuations. So I believe valuations are a response to the outlook, which is looking really positive in terms of business cycle, earnings growth, capex cycles picking up in the Indian context, where we have seen a lot of capex announcements by the private sector, public sector, which can fuel demand as we go along. So these are some of the positives which partly are already priced in terms of valuations as we speak. If I look at the near term and the long term outlook on the equity markets, I believe the risk and reward is balanced at the moment. On the near term basis, I believe there could be some downside risk, by the way, over the next near term 3 to 6 months. I will not rule out a downside from these levels. And therefore, we are recommending our investors to look at SIP option to come into equity markets rather than putting in lump sum. So near-term outlook is confusing, could be a downside as well. From a medium to long-term perspective, we'll still continue to believe that equities should do well and should be able to deliver returns which are higher than other asset classes, be it debt, be it real estate. So from that perspective, if one has a 3 to 5 years investment horizon, we believe equities should do well and better than other asset classes. So that's our house view, and that's how we look at the equity markets.
Yeah, thanks, Vishal, for mentioning about equity outlook, specifying about the short term, how it is going to be, and what are the things it is going to impact the market. So let us come back to the today's agenda, that is the fund specific, that is a small cap fund and a balance advantage fund. I think hardly you have taken over this fund 2 weeks back. And both are different set of funds. One is the too extreme fund, that is highly aggressive fund, small cap fund. The other side, it is a too conservative hybrid fund, that is balance advantage fund. So I think how just I want to take through one by one fund. The first fund is about our small cap fund, whereas our fund size is 2,700 crore, and earlier the fund was reshuffled and it was managed by our analysts driven fund. And post that, I think these changes happened 2 weeks back, and you are taken over this fund. So what is your philosophy going forward in ABSL small cap fund? What is the strategy you are going to adopt going forward to run this fund with the expectations of the partners and distributors?
Right. So yes, you're right, Thirumala. It's been just a couple of weeks that I have taken over these two funds. And honestly, I'm very excited to embark on this journey. I have spent 9 years in PMS, and I think the performance on that front is available in the public domain. Especially the small and mid cap schemes performance has been very strong and stellar over there. For the last 9 years, the CAGR returns in the small and mid cap category funds in the PMS side has been around 24% annualized returns for the last 9 years versus 17% for the benchmark. So almost a 7% annualized outperformance has got generated over there. On the back of very high conviction ideas which we have bought over there and have done really well. Stocks like Alembic Pharmaceuticals, we have been one of the first ones to identify those on the PMS side. And that's something that has become a 10 bagger for us. We invested at around 70 rupees and eventually exited around 700 rupees after a few years. Like Alembic Pharma, there are many other stocks that did really well for us on the PMS side. And the idea here for me is that as I take over small cap fund, to basically imbibe some of the winning formulas on the PMS side into this fund, and to see how we can achieve similar kind of performance on this platform. And mutual fund platform, by the way, as we all know, is very tax efficient. So from a scalability perspective, we believe that the same can be replicated over here. And that's the whole thought process, where I would like to see how we can add value for our investors on this platform, and bring about all the good practices that we have had in terms of identification of small and mid caps, and use that knowledge base to add value for this fund.
Okay, that's great, Vishal. I think look forward to see that success stories and what you have created in our PMS basket. The same thing in a small cap fund also. And based on your expertise, especially across market capitalization, the stock selection which you have done in small, mid, and small cap, and especially you have created an annual outlook for us, the trend spotting kind of a thing. It was well appreciated by distributors, where it was talking about different market cycles, different themes will drive the market, and you have specified those themes very clearly. So do you think the same themes are going to bet in the small cap fund also?
Right. So I think, Tirumala, the themes that we have enumerated in the trend spotting PPT, I believe are very relevant even today. And those are the themes which have some of these have already played out in terms of share price performance. We have seen some of the stocks from those themes doing really well. For example, the real estate theme, cyclical revival of real estate, for that matter, has done really well. And then you have manufacturing theme, digitalization, sustainability. These are the four broad themes that we have talked about in that trend spotting PPT. And a lot of these themes, the thought process behind that PPT was to look at 3 to 5 years time frame, and that we came out just 6 months to 1 year back. And therefore, these themes, we believe, remain relevant for the next 3 to 5 years. Although partly last 1.5 years, they have played out, but there is a lot of steam for these themes to play out over the next 3 to 5 years from these levels as well.
Okay, so according to you, the same small cap fund, currently we are betting more on software, consumer durables, chemicals. These are the top sectors. So these sectors will remain same. It's going to be, or is there any changes?
Let me just quickly relate those themes to the sector allocation that we are seeing here. The first theme that we talked about in the trend spotting PPT is rise of domestic manufacturing. So the domestic manufacturing, we believe, as a segment or a sector, should do really well from these levels, because of the fact that the kind of, apart from what we have seen in terms of PLI schemes, production-linked incentive schemes, where the government has given a 2 lakh crores of fiscal outlay for 13 sectors to develop domestic manufacturing. So that is one big push in terms of government reform for this particular segment of the market. But apart from that, we believe that there are a lot of other things which have been done in terms of corporate tax rate reduction for new capex from 25% to 17%. And then there was an import duty increase for some of the finished goods and components, let's say computer and its parts, mobile phones and their parts, which means that it is cheaper to produce domestically rather than import. All these things are leading to the fact that domestic manufacturing will get a push. Today, domestic manufacturing is around 14 to 15% of GDP. We believe this can actually move to 25% of GDP over the next 1 decade, and all the building blocks are in place for that. So if domestic manufacturing were to do well, what are the sectors which can benefit from this trend? We believe the beneficiary sectors could be chemicals, pharmaceuticals, defense, electronics, and auto ancillaries. These are the sectors that can benefit. And if you look at the top 10 sectors in our portfolio as well, you will see a color of these domestic manufacturing sectors, like chemicals comes in the top. Consumer durables, by the way, companies, a lot of durable discretionary companies are seeing domestic manufacturing happening. For example, Voltas has put in domestic facility for manufacturing. So be it consumer durables, chemicals, auto ancillaries, industrial capital goods are all the beneficiaries of domestic manufacturing. So that's the first theme, which is domestic manufacturing, and you can see sector allocations and which are the sectors which can benefit from the theme. The second one is digitalization, where what we are seeing is that there is massive push towards digitalization. Also, partly because of the pandemic, people have realized the importance of digital connect, where when there's a lockdown, even in those severe lockdown situations, people were able to connect with each other and conduct business, by the way, through digital means. And in our own mutual fund company, we have seen how digitalization came to the rescue for the company during the times when there was complete lockdown. So clearly, partly led by lockdown, but partly also because of the fact that we have a very robust digital infrastructure in the country, be it in the form of UPI-enabled transaction system, which has got developed very recently. And then you have Aadhaar enrollment system for identification. And lastly, because of the penetration of 4G, the affordability at which 4G has been rolled out on a pan-India basis, even in the rural areas, people are able to afford a 4G handset and also a data plan. So all these things put together, be it an infrastructure of UPI, Aadhaar, or availability of low-cost data, all this has resulted into pickup of digitalization in the country, where the digital transactions volumes have moved up dramatically, which is helping the space. And in turn, globally also, there is a focus on transformation in terms of business transformation, taking the business to cloud, etc., which has led to Indian IT services benefiting from this trend. So we believe the natural beneficiaries of digitalization in the Indian context to be companies within the IT services space, within online retail. Some of the companies got listed recently in the online retail space, fintech space, automation in manufacturing for that matter. Think of companies like Siemens and ABB, which are doing automation in manufacturing through robotics, etc. So these are some of the beneficiaries of digitalization. And if I look at the portfolio, you have software as the top sector weight at 12%, which is one of the beneficiaries of digitalization. And let me also give a caveat here that software, for that matter, some of the stocks have done really well in the portfolio, and we actually are booking profits in some of these names. So some of the themes have actually played out the way we expected. So that's the second theme that we talked about, which is digitalization. The third one is sustainability, where what we are saying is that um, sustainability is now being recognized not only by the governments as very important agenda to be driven, but also by corporates and consumers who understands the importance of sustainability going forward because of uh, because of the fact that even to some extent the pandemic uh, uh, might have been caused because of the imbalances in the nature. So that's where environment sustainability has become a focus area of not only the governments but also of the corporates and consumers. On that front, we believe the green energy revolution in terms of renewable energies, green mobility, by the way, green fuel in the form of ethanol for that matter, all these technologies are doing quite well and look really promising. And also during this conflict between Ukraine and Russia, the crude prices have actually moved up dramatically, which is again forcing countries and companies to adopt greener means of business or to focus on renewable energy as a source of energy for the country uh, to achieve self-sustainability. So all these trends we believe are going to accelerate the move towards renewables, and the natural beneficiaries would be sectors like green mobility, green energy, green fuel, etc. And the
That's great,
last
Vishal.
one, the last one, I think what we like is cyclical revival in real estate. And you will see some of the sectors in our portfolio in the small cap fund, like consumer durables, which also benefit because of revival in real estate. We have already seen registrations, by the way, on a pan-India basis, reaching all-time high in terms of residential real estate registrations, led by affordability, led by prices not going up for the last 7-8 years. Property prices are flat, whereas the affordability has gone up because of lower interest rates and lower EMIs. So all that is leading to real estate doing well. We believe the best way to play real estate space is through ancillary industries in the form of housing finance companies, home insurance, consumer durable companies, building materials, cement, etc. So that's the last theme, which is real estate, which we believe could do well from a 3 to 5 years perspective.
That's great, Vishalji. I think you have explained the themes very well. And what could be the ideal, the top 10 stocks ideal weightage you are looking? And are you looking long tail in small cap fund, especially in the industry? We have been seeing more than 100 plus stocks are there where we are not that kind of a long tail we have. So what is your view on that and how you are going to manage?
Right. So I think this is a pertinent question because one fund in the industry, the largest small cap fund in the industry, has got more than 140 stocks in the portfolio because of the size also, because the size is pretty big for that fund. I think for us, since the size is not that big, it works to our advantage where we can actually have concentrated holdings in the portfolio where we have high conviction and try to generate alpha over there. So from that perspective, smaller size comes as an advantage, and we would like to see that how we can optimize and monetize on that by having high conviction ideas with a higher weight in the portfolio. So you will see that the number of stocks in the portfolio would be lower than the industry average. If the industry average is 80-90, ours should be in the range of, let's say, 70 odd, or even less than that, 65-70. So that's the whole endeavor to reduce the number of stocks in the portfolio, have high conviction concentration bets, and also high conviction sector overweight calls. For example, wherever we believe that a particular sector will do well, so we have higher sector weights in those particular sectors.
Yeah. Going forward, how you are going to manage this fund? Because we had a bitter experience in terms of managing this fund, especially the liquidity issues we have faced in this fund. And how do you overcome those things, and how you are going to give confidence to our investors and distributors?
Right, right. So unfortunately, last few years haven't been good for this particular fund. Therefore, the mandate for me is to make sure that the experience from here on improves dramatically for the existing investors. Yeah, and that's the whole objective. And from that perspective, I think clearly the first objective is to ensure that we are placed in the right sectors and right stocks with the right weightages that we discussed. I think that will solve a lot of issues where when the portfolio, let's say earlier, was underperforming, the objective is to make sure that we bring it back on track over the next few quarters.
Okay, that's great. In the interest rates rising scenario, currently, the small cap fund companies are more leveraged, and and governance issues will come. So how these companies going to behave, and how we are going to accommodate in our portfolio going forward?
Right. Yeah, that's a pertinent question, Thirumala, that during the rising interest rate scenario, how will the small cap companies get impacted? So for that, I think it's really important to be in the right stocks and the right sectors. As a philosophy, what I have been doing is that idea is to invest in leaders in the emerging sectors for the small cap fund. What I mean by that is that we identify very, very strong companies in sectors which are emerging, which have very high runway for growth. If you look at the sectors like diagnostics, for that matter, diagnostics has got a lot of unorganized exposure, but the organized sector companies are doing really well, and they are eating into the unorganized market share. So if you are able to identify good high quality companies in the diagnostic space within the organized space, they will actually outgrow the industry growth because they will cannibalize on the unorganized sector market share. So that is one strategy, to participate in sector leaders in emerging sectors, be it diagnostics, be it healthcare, be it, let's say, emerging chemical companies for that matter. So that's one strategy. So what it does is that it reduces the risk of the portfolio, because these companies are very strong financially speaking. They don't have leverage, and they are able to grow through internal accruals. So even in a rising rate scenario, these companies will end up doing better, because the weaker companies will get cannibalized in that sector. So if I look at the right hand side, the top 10 holdings in the portfolio in this particular slide, you will see that many of these companies, almost 7 out of 10 companies are debt free of the top 10 holdings in the portfolio.
Yes, yeah.
Right, which means that even if the interest rates were to go up, the portfolio should do well.
Okay, that's great, Vishal. Is it right time to invest in small cap fund at this point of time, and how do you manage the downfall risk in case if there is a short-term volatility arises in the market?
Right, right. So I think, as I mentioned, on a near-term basis, next 3 to 6 months, our view on the markets is cautious, and we do not rule out a correction in equity markets because of the emerging geopolitical tensions in Europe. So given that backdrop, we believe next 3 to 6 months could be volatile, and which is where we would advise investors to come with a medium to long-term investment framework in mind. So if the investor has got 3 to 5 years of a time frame, investing time frame, then he should go for a small cap fund. And with a SIP plan, because systematic investment really smoothens out the volatility in equity markets.
Okay. And small cap universe is very large, and especially we are looking this fund to be scalable to 10,000 crore going forward. So in the rising in AUM scenario, how your strategy could be, and how much is your ideal size you are looking, and you are comfortable to manage this fund?
Right. Yeah, I think considering that small cap category per se in India would be around 1 lakh crores plus. I think it will not be a challenge to anticipate or envisage this fund reaching 10,000 crores of AUM in the next few years. I think that is very much possible. And I think it's very much manageable as well, because the average size of the AUM in this space is around 6 to 8,000 crores right now, with the biggest fund being 17,000 crores AUM. So I think I don't think there's a challenge reaching 8 to 10,000 crores, beyond which it might be challenging to scale it up beyond that.
Okay, so what could be the ideal time horizon you are looking in the small cap space if any investor wants to come today, and what could be the return expectation they can look at from investor point of view?
Right. So I think very difficult to give a number there, but I think small and mid caps should ideally deliver returns which are a couple of percentage points higher than large cap funds, though at the cost of higher volatility. And that is the reason why we would recommend investors to come with a time horizon of 3 to 5 years, and don't come with a short-term time horizon. With a 3 to 5 years kind of a horizon, we believe a 2 percentage points higher returns than large caps is doable.
Okay, that's great, Vishal. I think small cap. I have noted a lot of points on this fund, and let's move to balance advantage fund. This is another conservative hybrid equity fund. Most of the investors expect in this fund consistency. And the second one is they look returns FD plus 3 or 4% kind of a return they anticipate in this fund in the horizon of 3 to 5 years space. And tax efficiency and all these benefits are there. So they look consistency in this fund. So what is your philosophy, since you are going to take over this fund first time, how you are going to run this fund, and what is the strategy you are going to implement going forward?
Right. Sure. So Thirumala, the good thing is that on the PMS side also, we have had asset allocation strategies that we have been running on the PMS side. So from that perspective, I have managed some of the asset allocation strategies there. So it doesn't come as a completely new thing for me to manage the Balanced Advantage Fund. And as you know, the portfolio construct is pretty conservative. Here, there is utmost importance given to downside protection. And the investor coming here is a conservative investor. If I look at the mix of the portfolio today between equity and non-equity, it would be 45, 55. 45% equity and non-equity will be 55. Non-equity will include arbitrage as well as debt. And because arbitrage and equity is 65% plus, the fund gets the benefit of equity taxation, which means that the taxation for investor holding for 1 year plus time horizon would be at 10%, which is the equity taxation, long-term capital gain tax on equities. So I think there's a dual benefit here. One is it's a conservative construct, and second is tax advantage, as you rightly mentioned. In Balanced Advantage as a category, by the way, there is another feature which is the dynamic asset allocation, where we have the leeway to change the asset allocation between equity and debt based on market levels. And what we do here in Birla Sun Life AMC for this particular fund, Balanced Advantage Fund, is that we have a very, very defined framework of asset allocation between equity and debt based on the price to earning multiple range. As one can see in this particular slide, this particular table, which talks about the P multiple range and the average 3-year future returns. One can see that when the P multiple range, trailing P multiple, is lower than 15%, then the average future 3-year returns are much higher at 37% annualized. As the P multiple goes up, the starting P multiple, the average future returns come down sequentially as the P multiples keep on increasing. So that is the reason why for our balanced advantage fund, we actually invest into equity markets. The exposure that we take into equity markets depends upon the PE multiple range. So if the PE multiple range on a trailing basis is below 14%, 14 times PE multiple, then the equity exposure would be in the range of 80% to 100%. Again, this is what one can see on the top left-hand side table here. When the adjusted PE range for S&P BSE 100 index is 14 times PE multiple, then the equity exposure is 80 to 100. As the PE multiple moves up, the net exposure to equity keeps on coming down. Today, by the way, as we speak today, the trailing price to earning multiple is 23. And therefore, the equity exposure is lower at 45%. As one can see here, 44.66% is the net equity exposure, because the S&P BSE adjusted PE multiple is 22.56 as on end of March, which as on date today, by the way, is 23 times. So that's where the positioning is conservative, where equity exposure is less than 50%. What we have done in the past, by the way, is that as the markets have moved down and the PE multiple has corrected, we have increased equity exposure in the past. As one can see here in this right-hand side table, in March of 2020, as we all remember, during the peak of COVID crisis and during the peak of correction because of COVID-led fear, the equity markets globally went into a correction mode and correcting almost 40 to 50%. At that point of time, the trailing price to earning multiple of the index came down dramatically. And we took that as an opportunity to increase our equity exposure to 75% in March of 2020, which was 1 year back around 52%. It went up to as high as 75% because the trailing PE multiple dropped to 17.15%, 17.15 times. And we took the advantage of the market fall, and which is what helped the returns over the last couple of years. So I think it's a dynamic asset allocation model, which also adds value to the investor. When the markets correct, automatically based on this framework, the equity allocation goes up, and vice versa is also true. When the markets go up, we book profits and reduce equity allocation.
Yeah, I think more clarity is there in terms of PE valuations and how our equity exposure we are going to manage. The another question I want to ask you is how you are going to construct the sector allocation and large and mid small allocation, especially this equity portion out of this 46 or 45% current exposure.
Yeah, so far as the balanced advantage fund goes, the mandate is pretty clear. Risk downside protection is more important than capturing the upside. Upside capture will definitely happen whenever the markets correct, PE multiple becomes reasonable and the equity allocation goes up. So that is inbuilt into the model where your equity allocation increases when the markets correct. And at the same time, there's from a framework standpoint, downside protection is really important. Therefore, for this particular fund, the large, mid, small allocation is more in favor of large caps, where 70 to 75% allocation is into large caps, and balance 20-25% goes into high quality small and mid caps, where the beta is lower and the downside risk is lower. So that is how the construct on the equity side happens. For example, today, if I look at the portfolio, we have some of the, let's say, stocks where we believe downside is very limited. Stocks like ITC, for that matter, which are high quality consumer companies, very high dividend yield at 6% dividend yield. So some of these companies work as downside protection during such markets, and sometimes also give upside when the markets do well.
Okay. Yeah. Okay, Vishal. And in terms of mitigating the downfall, as you rightly mentioned, you follow the PE model, and But what are the to reduce the volatility in the fund, especially we are seeing recently in the last 6 months time in terms of returns, when we compare with peer group, there is a volatility in the returns where most of the advisors are looking consistency in this fund. So how you are going to manage this, and what kind of measures you will take it forward to reduce this volatility in the fund, so to give a consistent returns as per the peer group.
Right, right. So in this case, what we have seen in the past also that on a 3 month, 6 months basis, many times the performance vis-a-vis competition for that matter is a bit volatile. But on an annual basis, for that matter, the performance has been pretty stable in the past. And even today, if I look at the 1 year performance, we are in the top 2 quartiles, maybe Q2, and longer term performance for this particular fund has been pretty consistent between Q1 and Q2 across time frames. As I look at the short-term performance, 6 months performance would not be as great, maybe Q3, but again, 3 months, 1 month is good. So we believe that this short-term is something that one needs to be aware of, but not too much worried about, because medium to long-term should be taken care of, because the framework we believe for this particular fund is time tested and pretty robust. And that's what gives us confidence, and that the volatility, we can tide over it over the course of the time.
Okay. So according to you, what kind of investors can invest in this fund, and what is the time horizon you suggest to them, where the investors are looking alternative to FD, especially when the FD returns are very low, and ready to take a little risk and tax advantage by entering into this fund?
Right. So I think if one looks at the long-term track record of this particular fund, one will get a sense of how what kind of returns have been generated over the period of time for this fund, and what can be expected based on that. If I look at the 10 years kind of a return for this particular fund, that is around 11% kind of a return, annualized returns for the last 10 years. If I look at short, let's say medium term 5 years returns for balanced advantage fund, 5 years return is in the range of 8.7% kind of a number. And post that, what we have seen that the interest rates have come off a bit, which have again started to go up. So higher interest rates will actually benefit the debt part of the portfolio. So from that perspective, we believe that FD plus 1% or 2% is the endeavor in the medium to long term that that this fund would generate. Having said that, I think since there's equity allocation of 40-45% as we speak today, the path to that FD plus 2% will be volatile. But I think it is the investor gets compensated for that, taking on that volatility because of the extra margin vis-a-vis fixed deposits, and also lower tax rate. Particularly if an investor comes in the highest tax bracket, then for him, this is a very tax efficient way of investing, where one is paying 10% tax rate versus maximum marginal rate on the debt side of it.
Okay. That's great, Vishal. I think I'm convinced about your ideas and your strategy going forward to manage this back as per our prescribed the PE model. Any other additions or any other downfall protection mechanism you are going to adopt, because to reduce the volatility, especially in the coming short-term volatility, in case if war kind of a situations, issues will pop up again. So how you are going to manage it?
Right. So I think so far as this fund is concerned, which is Balanced Advantage Fund, there is a lot of flexibility and there are a lot of options available to hedge the downside. One is to take to buy puts when to tide over short-term uncertainty, like you mentioned about the war, escalation, etc. So in that scenario, one has the option to buy puts on the index, where one is paying a small premium and getting the downside protection. It's like a small insurance premium for downside protection. But if the downside doesn't happen, then the premium is lost. So that's one. Second is going short Nifty to protect the downside rather than selling stocks that we are owning the portfolio. If we want to hedge the portfolio just for 1 month or 2 months, the better way of hedging that is through buying Nifty by shorting index like Nifty short. As we speak today, the Nifty short position in the portfolio is around 3%. So that's also one mechanism which is available in this particular fund to hedge the downside. And we keep on evaluating these options based on the situation and try to use the best option which is in the best interest of the investor.
That's great, Vishal. I think overall, I think small cap and balance advantage fund, I think both, I think different directions in terms of risk. Both are small cap is aggressive fund, whereas this balance advantage is a conservative fund. So if anybody wants to invest right now 100 rupees, so the long-term horizon, so you which fund you suggest first, like a balance advantage fund to enter or a small cap fund to enter with a standard manner?
Yeah. So I think, Tirumala, it depends upon the risk appetite of the investor, the kind of investing experience, maturity the investor has with equity markets and comfort with volatility. So it will vary from investor to investor. But what I would suggest is that for the investors who are just starting out, they should start with conservative funds like Balance Advantage Fund, and then move on to riskier parts of the market, which is small and mid caps.
Okay, that's great, Vishal. I think no more questions from my side. I'm just checking, is there any question in the chat box? Dear investors or partners, request all of you to please post your question in the chat box so that we can ask the same question to our fund manager. So one question is coming, the major part of portfolio are invested in own Aditya Birla funds. Your views on it, you can take direct exposure to AAA, NCD and CPs. It might provide the return kicker. Oh, I think he's asking about views on it can take direct exposure, I think, NCD. I think BAF is asking, we have invested some of the money in liquid in debt fund, in our overnight fund, I think. That way, I think he's asking.
Right. So let me just answer that. So you can see, let's say one is CBLO exposure, which is CBLO is quasi cash. So we do not keep any cash in the portfolio at the end of the day. All cash is invested in CBLO bonds on an overnight basis, and the same is available for use next day morning. So that the investor doesn't miss out on any return. Let's say if we have 3% cash in the portfolio, that daily basis that cash will go into CBLO, and it will still be available for investment in equity markets if we want, but otherwise it will be parked over there on the overnight market, and it will earn some 3-4%, but that 3-4% is better than 0%. Second is liquid mutual fund investment in case of Balance Advantage Fund. That would be around 6-7% investment in liquid fund. Now that is also having a particular purpose particularly for Balance Advantage. What we do is that for the arbitrage part of the Balance Advantage Fund, where we are doing arbitrage, where we are going buying in cash and selling in future for earning that arbitrage carry, which is let's say 4-5% carry. For that arbitrage book, we need to give margin to the exchanges, to the stock exchanges. So that margin we can give in cash, but that cash will not earn any income. So what we do is that we give margin in the form of liquid mutual fund, liquid fund to the exchange. And this arbitrage book continues throughout the year. So this liquid fund, 6% or 7% of the portfolio is given as margin to the stock exchanges for the future position, F&O position. And this liquid fund will earn 3-4% return and will sit as margin with the exchanges and custodians. So that way, The endeavor is to make sure that no cash is lying idle in the portfolio. And let's be assured that the liquid and CBLO is also being kept only to the regulatory minimum, and the rest all is deployed in high yielding assets. So we have been trying to optimize that, and the kind of exposure in liquid and CBLO is the least minimum that we can work with.
Okay, thanks, Vishal. I think somebody is asking, show the portfolio. The small cap fund, top 10 holdings and the top 10 sector allocation, you can see in the presentation. Mr. Ranjit Kumar is requested to show the portfolio. I'm just putting this, and then so dear partners, if you have any question, please put it in the chat box so that I can ask the question directly to Vishal. If you have any questions, please put it in chat box. Yeah, meanwhile, Vishal, one question I've been getting on the other side, the dividend part where we are consistently declaring the dividend in this fund. Is there any chance if we get a surplus kind of a thing, is there any chance to increase the dividend rate what we are declaring right now going forward?
Right. So dividend right now for the Balanced Advantage Fund is around 6% annually. So that is something that is the dividend payout for FY22 last financial year. The dividend for this financial year is basically going to be finalized in the next 1 week. So post which I'll be able to give a better indication on that front.
Okay, that's great, Vishal. I think I'm not getting any indication in terms of questions. So once again, I'm just reiterating. I think one more question came. Yeah, BAF was doing well for past few years. Then why sudden fund manager change? I think earlier Vineet Malu was managing this fund very well, and he was doing consistent in this fund, and he has stabilized this fund from the volatility point of view. But he has moved as per career progress to the group level, AVZ group level, and then post that Vishal is taking over this fund. So you can, I think Vishal, I think you can add some comments from your side.
Right. So the previous fund manager, who is Vineet Malu, has actually done a very good job on the Balanced Advantage side, and he has consistently managed this fund really well over the years. Unfortunate for us that we had to let him go, and he joined the group firm, one of the group. He actually joined the chairman's office. And so from his career progression perspective, we believe that was the right thing that he did, and we let him go. So that's a loss to our firm. And so that's the background why there's a change in fund manager here.
That's great. Just I'm requesting once again, please go through the chat box. There is a link is posted where you can go through last week voyage event curated recording links are there. So you can go through this long weekend where you can go each and every speaker speech you can listen. So I think I'm not getting any other indication. So the time is also over what we have scheduled. So, okay, he's asking BAF portfolio. Okay, 1 minute. I will show him BAF portfolio. Vishal, 1 minute. He's asking BAF portfolio. And just open that file and I'll share. Yeah. The Excel sheet is visible. I have disclosed
it is.
balance advantage fund portfolio as on 31st March. So these are their top 10 holdings.
Yeah, so just to clarify here, as I mentioned, the liquid fund investment is basically given to custody and stock exchanges as a margin money for the arbitrage part of the book. And so the top 10 equity holdings start from HDFC Bank, followed by ICICI and so on and so forth. The equity exposure is 45%, balance is debt and arbitrage.
Okay. So this is the sector allocation. Banks, we have 16%, and fixed bonds, again on the debt side, 14.5%. Investment funds, mutual funds, again that liquid part, 6.9%. Software as a sector, we have exposure 6.8%. Petroleum products, 6.59%. Consumer non-durable, 5.33%. So money market instruments, again that liquid side, 5.06%. Finance, 4.88%. These are the top sector-wise allocation.
Sure. I think there are no more questions, so we can wind up the call.
Yeah, sure, Vishal. Thanks. I think no more questions, so I'm just pausing it. Yeah. Thank you. Thank you, everyone. Thank you, Vishal, for taking your time and joining for today's session. Thank you all our MFD partners and our investors, as well as our investors who joined us today. Thank you so much for sparing your time. Look forward to having you in this platform on regular basis. Till that time, stay safe, take good care of yourself, and have a great evening ahead, and also have a long weekend ahead. Goodbye to all of you. Thank you very much once again to join this Navigator series, expert series with Vishal. Thank you.
Thanks, Rumala. Thank you, everyone. See you guys.